In this video, we're going to talk about another type of derivative security called a future. So we're going to discuss the futures market. What is this? How is it used? And what we'll find is they're very, very similar to options. So in this case, instead of looking at individual stocks, we're looking more at what are referred to as commodities. Gold, corn, oil. These are the things that are traded in what's referred to as this futures market. So what does the structure look like? Well, there is a cash market. There's a cash market for everything. This basically talks about or shows where a physical product is exchanged for cash. What is the cash price on that exchange date? That's sometimes referred to as the spot price. Now, the futures market is an organized market for trading what's referred to as futures contracts. And a futures contract is a commitment to deliver a certain product at a certain date at a certain time. Should sound very similar to an option. The delivery month, when these are to be delivered, much like the expiration date on options, tells specifically when that commodity must be delivered, and therefore that is the life of the product, the contract. They have their own trading hours. Actually, different contracts can only trade, maybe they'll only trade from 8 to 9 o'clock every day. So the contract trading hours vary pretty widely by the type of security that you can think of. And the market value of a single contract, you find the size of the contract and you multiply that by the quoted price of the underlying commodity. And all trading in a futures market is done on a margin basis. So let's look at contract size first. If you look at the contract size here, again, it's a little different than you think about a stock option, or when you buy a contract, it's for 100 shares. When you buy a contract for corn, it's a contract for 5,000 bushels. And the market value of a single contract is $21,013. This was on July 9th of 2015. And that is the price for the next expiring future for that particular contract. And as you go down the list, you can see that most of them are obviously some serious money, but some of them are pretty extreme, like an S&P 500 stock index contract. The value of a contract is roughly a little bit over $500,000. So this is the size of the contract, the thing that we're talking about. Now, imagine this size of a contract, but now you are buying on margin. And the size of the contract changes as the price per bushel changes. So if the bushel, if the let's say corn goes up by 10 cents per bushel. 10 cents per bushel means that goes up, in this case, it would be $500 is the increase in value of a particular contract. So it'd go from 21,000 to 21,513. So the increase in value is very similar to the increases in value when you think about options. The value of the contract changes based on the change in the price of the underlying asset. So again, we talk about options and futures, very similar. They both involve future delivery, agreed upon prices. We've talked about the concept of derivative securities. Surely we're aware of those things now. But let's talk about how they are different. An option is the right to buy something. You can choose not to act. When you buy a futures contract, you were obligated to buy that product sometime in the future. So again, if you go back here, if you buy a corn product, right? You buy a contract on corn, you are obligated to buy 5,000 bushels of corn. In this case, it would be December, right? And I think that's when these all, maybe it was whatever the exercise price was. But let's say you bought December corn, you would have to buy 5,000 bushels of corn in December. Now, as you'll see in a slide coming up, less than 1% of all futures are ever closed or ever settled for delivery of product. So we'll talk about that here in a couple minutes. There was a strike price that's specified in the contract. The delivery price for the futures contract is set by supply and demand. So the ultimately delivery price, the return, is ultimately determined on a day-to-day basis as time changes. There's an upfront cost or a premium with options, and in this case there's no upfront cost per se of buying a future. You're buying just like you buy stock, but you're buying usually at margin. Now the loss, if you buy an option, the loss is limited to the price you pay, but with a futures contract, the loss is unlimited, right? There's no limit to how much money you can ultimately lose when you purchase a futures contract. Now there are many exchanges. Most have been combined into one exchange now that's called the CME group, right? So it's an exchange just like any other exchange that you can think of with respect to stock exchanges. Historically, the way options traded was through something called an open outcry auction. Essentially, traders would be in a circle called a pit, and they would be yelling their orders using all kinds of hand signals and pushing and shoving, etc. Most of that has disappeared now. There are a few contracts that are still done on open outcry, but most exchanges now conduct trading electronically, so that that physical contact is not as prevalent as what it used to be. And of course now electronic trading is it's done globally, right? So there's an international link to most futures markets across the world. So just like with options, there are two ways that we trade, or strategies, if you will, of why people buy and sell futures. Primarily, it's done as a hedging activity. Businesses either produce a commodity or they use it in their production process. The goal is to protect profits. So they're going to protect their interest by buying or selling contracts. So in the end, they can essentially lock in prices, right? So they want to try to manage a price. If you kind of think about a farmer in the spring, right, they're not going to recognize or realize their profit until the harvest in the fall. So how can they control the profit they're going to make when the price that they're going to receive is so far away? They can do this by buying and or selling futures for future delivery, locked in prices later on. And as they mentioned here, this is really the existence for futures markets, is to enable the production side to work with the supply side of products so that both sides can lock in and manage the profits of assets that sometimes can change quite wildly. And of course, there is a speculator side. Again, these are people that simply are looking at price swings. They have no intention of ever taking delivery of product. So these are our investors, if you will. Their primary job is helping us to provide liquidity to the market. So if you think about the mechanics, right? These are contracts easily traded. They're bought and sold through brokerage offices. Some are types of orders are the same as they are for stocks. Margin trading is standard. So if you take a long position in a futures contract, you're buying a contract. That means you want the contract price to go up. If you take a short position, you're selling a contract and you expect the contract price to go down. The long and short positions can be liquidated just by what's referred to as an offsetting transaction. So if you want to get out of a contract or an investment that you've made, you just have to unwind it. How do you unwind it? If you bought a long position in a contract, you would then go out and sell a short position in that contract. So now you have a long and short position on two things, and they offset each other. And as they mentioned here, only about 1% of all futures contracts are settled by delivery. Open interest, just like we talked about with options, is the total number of contracts that are open and haven't been settled by delivery or by an offsetting transaction. There are round-trip commissions. We've talked about margin trading. By now, I'm sure we understand what margin trading means. There's a margin deposit, right? Margin requirements typically range from 2 to 10%. So think about this. We have a contract worth, when you looked at the corn contract on a previous slide, right? We knew what the actual price was. It was roughly $21,000. What if you only had to put up 10% to buy that? So for $2,000, you could buy something worth $21,000. And that value of the $2,000 thing that you make goes up dollar for dollar from the derivative asset. So the leveraging capabilities and possibilities are huge when you think about futures markets. However, on the downside, there's no floor like there was with options. Where an option, if you bought a call, the worst thing you can do is lose the premium. That is not true with futures. You have an unlimited capability of losing money. The maintenance margins, just like with stocks, it's the amount that has to be required at all times. And of course, if it falls below that, there are margin calls. Now, what's a little bit different than with options and any other investment you can think of is that your margin position is checked daily. So what they refer to this as mark to market. So every day your account, for instance, will be changed based on the change in your contract for that day. So that's what's referred to as mark to market. So when we look at margin requirements, again, corn, the initial margin, again, this is July 9th, was $1,375, which basically means on a $21,000 contract, you have to put up $1,375. And you can see as you go down through the variety here, some of them are various. I mean, sugar is $770 is the contract. And if you look, some of these look like they're 10%, some of them are a little bit more, and they give you a little bit deal down here. Quite frankly, since margin is a risk that you take, but is sort of financed through the brokerage house, they have determined that you have to state whether this is a speculative investment or a hedging investment. Hedgers don't have to pay as much or have different margin requirements than speculators. So again, I don't expect many of us to ever be in the futures markets. But let's take a real quick little view of what we're talking about when we talk about futures. We're talking about physical commodities for the most part. Grains, wood, meat, metals, right? These are all the commodities that we talk about. They're fungible goods, right? That they are the same regardless of the supplier. So if you think about corn, right? there are really many, many different grades of corn, just like there's more species of corn, right? There's sweet corn and there's Indian corn, but even within that range, there are grades, if you will. So when you look at a contract, the specific grade of corn is specified for that contract. So again, as long as the product that you're talking about meets this standard, it can be traded with futures and can obviously be delivered in the end. And again, investors can choose from dozens of commodities in the market for all kinds of commodity contracts. So you could buy grade A corn, grade B corn, etc. The major classes of commodities, right? We have agriculture products, livestock products, metals, food, and then there's some other things. There's energy, right? Electricity. Well, that's really not something you can talk about, but there is a futures contract that you can buy in electricity. And then there are some other things. You can buy futures on weather, on real estate, interest rates, right? A variety of other things, if you will, that you can buy contracts on that are what I refer to as futures contracts. Now, some of these things you can obviously deliver. Some of these you can't. I don't know how you would deliver electricity. Not sure how you would deliver the environment, right? So some of these things will always be satisfied with cash. Some of them would be required that if you settle on the settlement date, that you would actually provide that product to whoever had sold the contract itself. So that's the first video on futures.